Up in today's show, stocks fall and bond yields rise again, what Buffett said about the US government credit downgrade, hedge fund billionaire Bill Ackman shorts 30-year treasuries, Bank of England hikes rates, a look into Apple and Amazon's earnings and the market's reactions, plus a look at other earnings like Robinhood, Etsy and the travel stocks, and technical analysis of all the most important charts today. Welcome back to the Click Capital Daily Show, everybody. My name's Jared. I'm going to take you through all the most important news, data and charts from the markets today. So hit that subscribe button if you haven't already, because I make these videos every day after market close and I'll keep you updated with everything that's happening out there. And so we're still getting through Q2 earnings season and the market's still digesting that news from Fitch Rating Agency, which on Tuesday night downgraded US government debt rating from AAA to AA+. And so the market was a bit mixed here today. We actually saw a bit of selling in REITs and utilities. And just looking at the 15-minute chart of the SPY, S&P 500 ETF, we did gap down this morning, managed to find a little bit of support earlier on, traded up to lunchtime, then reversed course again and closed lower again. We also had the US government bond 10-year yield move up today, reaching almost 4.2%, and the 30-year government bond yield ripping even harder. And stick with me and I'll explain to you why Bill Ackman has just got short the 30-year government bond, as he thinks rates are going a lot higher. So the market's still digesting this news of the biggest downgrade on US government debt since 2011, and anybody that reads a newspaper knows the US has a long-term debt problem, and the politicians aren't likely to cut their spending habits, and the percentage of debt versus GDP is likely to keep accelerating over the next decade, and the politicians will likely keep kicking the can down the road. However, that isn't such a big problem right now in the markets, as US Treasury bonds are still considered the safest asset in the world, with the deepest and most liquid market as well. And that's why Warren Buffett, one of the largest owners of Treasury bills, isn't worried at all, and not normally one to stoke fear out there. He said there are some things that people shouldn't worry about, and this is one. He went on to say the dollar is the reserve currency of the world and everyone knows it. He actually buys about $10 billion worth of US Treasuries every Monday in the weekly auction as he rolls over a large portion of his cash balance into T-bills, with about $104 billion out of his $130 billion of cash and equivalents in T-bills. That's versus his equity portfolio of $375 billion, and the telling part is he's only got $23 billion in bonds. So he keeps most of his cash in short-term T-bills, and he's not exposing the Berkshire portfolio to much interest rate risk, as he only has a small portion of the portfolio in long-term bonds. And we also had a tweet out today from billionaire hedge fund manager Bill Ackman, who's only surprised how low US long-term rates have remained in light of higher levels of long-term inflation. He said he'd be very surprised if we don't find ourselves in a world with persistent 3% inflation. He said because of the huge US government debt and growing deficits, the Treasury is going to have to keep issuing a lot of new bonds. And we saw that a few days ago with the Treasury Department estimating they need to sell about $1 trillion worth of bonds in just the third quarter alone. And so the more bonds the Treasury has to issue, then the higher rates investors will demand to be compensated for the extra supply out there. Then he also mentions China's desire to decouple financially from the US, yield curve control ending in Japan, and the growing concerns about US government's fiscal responsibility and political divisiveness. He's saying all those things should increase the 30-year T-yield, which is currently at 4.3% to 5.5%. And so when yields increase, bond prices go down. And if he's right, he should do very well, as he says he's short in size. And he's doing that as a hedge on the impact of higher long-term rates on stocks. And he believes it's a high probability standalone bet on its own. And it's not that far-fetched to think he may be right. Just looking at a long-term 3-month chart here of the 30-year government bond yield, it has been a while since we've been at 5.5%. We almost got there in April 2007. However, it hasn't been since April 2004 that the long-dated government bond was at 5.5%. And some of you may remember how high rates had got in the 80s, coming out of the inflation from the 70s. And this huge big downtrend in long-term rates is what's really helped the stock market over that same period of time. However, like Ackman says, 3% inflation may be structurally built in now, and that should keep a tailwind on yields going higher. But like we've been seeing this year, stocks haven't been pricing in higher inflation, they've been pricing in lower inflation, which we have been getting this last couple of months with softer prints. However, like Wells Fargo says, stocks could see a sharp sell-off if the possibility of resurgent inflation comes to fruition, and we'll just have to wait for the next CPI print, because we do have a tight jobs market and commodity prices back on the march higher. So if we don't get a higher CPI print this month, it may come through next month with a bit of lag there. Also battling inflation across the pond is England, with their central bank just raising their interest rate 25 basis points to a 15-year high of 5.25%, the 14th consecutive hike. and they're dealing with a bit more inflation than the States, with headline consumer price inflation coming in at 7.9% in June, which is still well above their overnight rate. We've got some big earnings out today, with the stock market's biggest company, Apple, showing a drop in revenue as iPhone sales underwhelm. They reported third quarter net income of $1.26 a share versus $1.20 a year earlier, but revenue fell to $81.8 billion from $82.9 billion. Apple doesn't give guidance in their earnings, as has been the case since the start of the pandemic, so we'll just look to the market's reaction and what it thinks of the quarter and the numbers. And just looking at a 5-minute chart here after hours, we are selling down off 2.5%, so that's currently $186.40 a share, which is lower than the 50-day VWAP, 190.65, and we haven't been below that for a few months now. I'd have to go back to early March when we just briefly dipped below that 50-day VWAP, and so we broke that tight parabolic trend line yesterday and closed down a bit lower today in the regular session on volume. And if we hold under 190 tomorrow and gap down under 190 and don't manage to close above 190, that could be a little bit of a confirmation of technical deterioration in Apple shares, and maybe this tight parabolic uptrend is over. And then just looking at the weekly chart of Apple, it has been quite the run this year, getting up to almost 200 after starting down at 123. And if we saw a 50% pullback in this move, that would take us down to the low 160s. However, more shallow, a dip of 38% pullback would take us to about the low 170s. We also just got quarterly results from the fourth largest company in the US stock market, Amazon, and they posted a pretty good beat, showing a return to double-digit revenue growth, giving some good guidance. Actually posted 65 cents a share in earnings versus 35 cents a share expected, and it's pretty rare the street will miss by that wide a margin. And they beat a little bit on revenue, 134.4 versus 131.5. AWS came in a little stronger than expected. Advertising was in line, and the market's absolutely loving the result, up 9.7% as I speak in after hours here. And just looking at a weekly chart of Amazon, still well off its all-time highs. A little bit below 190 a share, but looks like we're going to gap up tomorrow to a new year-to-date high. And overall, that's helping the Nasdaq a little bit, currently trading up 17 basis points after hours, and that big gain on Amazon is offsetting those losses in Apple. We also got meme stock broker Robinhood falling today hard after their earnings. That also showed monthly active users plunging by 1 million in the second quarter. And even though the company beat on expectations and posted its first profitable quarter ever, the market still didn't like it, marking the shares down 7.2%. Also got a few travel stocks out today with their earnings. Airbnb results beat expectations. They also said they plan to expand beyond its core product. They reported net income of 98 cents a share. That's up quite big from 56 cents a share last quarter, same quarter last year, and revenue climbed 18% as well. Market wasn't too excited though, finished down 2.55%, down another 1% after hours. And as the back of weakness in other travel stocks like Expedia, which fell pretty big today, down 16%. TripAdvisor came off 8.8%. However, contrasting that, we got Booking, who just reported their earnings as well. Came in with a pretty good beat, and the market's up 11.7% after hours. Also out with earnings yesterday afternoon was Qualcomm. Came in with a slight beat, but soft outlook, and the market sold them off hard today as well, down over 8%. PayPal as well, after yesterday's earnings, got hit hard today, down 12.3%. Over to economic data today, we got some weaker PMIs out of Europe. Initial jobless claims in the States came in as expected, and a bit weaker than expected services PMIs. And services has actually been holding up a lot better than manufacturing over the last couple of months, which has been in contraction territory, and services looks to be trending that way, but still a little bit above 50. And tomorrow will be the big one, with non-farm payrolls and the unemployment rate. Expected to do well because the jobs market has been holding up very well lately. And the Fed Fund futures market, still not entirely sure what the Fed's going to do next. Still given an 18% chance they'll hike next month, and almost 1 in 3 chance they'll have it done by November. And you can't keep the fear and greed index down for long, already starting to creep back into the extreme greed zone, even though the market came off again today. And that's largely due to the options market, still lopsided with calls. And it looked like dark pool traders showed a little bit of interest in buying the dip here, but still pretty low levels compared to the last couple of months. Corporate insiders appear to be a bit more nervous though, increasing their sales yesterday to 187 versus 39 purchases. Okay, back into the charts. S&P 500 sitting right at 4,500, a little bit above its 50-day VWAP, which we've got at 4471. And the losing index today was the S&P 500 equal weight, as we did see a little bit of a deterioration in the breadth out there. And same with the international stock indices, all coming off a little bit as well, with some touching or below their 50-day VWAP. Contrasting that though is the China A50 index, which is still holding up pretty well, and the Nikkei breaking down to multi-week lows, with the Aussie 200 just staying above it. VIX actually jumped to 17.4 today, but finished lower as the market rebounded in the afternoon. Still under 16 here, and a little bit flat up the front. We've actually got the new VIX one-day index above the 9-day and less than a point between the 9-day and the main VIX 30-day, but still a little bit higher at the back on the 3-month and 6-month. A little bit of a jump up in bond market volatility with the MOVE index at 124, and there's that deterioration in the breadth. Amount of stocks above their 20-day average falling 13% today to 43%, but we've still got the majority of stocks above their medium-term and long-term averages. Stocks making new highs continues to be weak, with a little bit of an uptick in stocks making new lows. Still got the growth versus defensive sector spread holding up, and commodities starting to perform a bit better than stocks. With inflation expectations continuing to tick higher. Got the Fed sensitive 2-year yield still pretty flat here at 488, and same with the Fed fund futures market. September and December contracts still pretty flat. Market's not quite sure if the Fed's done or not. And with long dated treasury yields continuing to rip higher, that's caused TLT to sell off again quite dramatically today, down 2.3% on above average volume, and looks like we may come down and test those lows from October last year around 92 a unit. And we're seeing a similar pattern in investment grade debt and high yielding debt as well. Dollar had a little breather there today at 102, and Bitcoin still pretty flat as well, just above 29,000. And commodities still trading strong even in the face of a stronger dollar, with gold still hanging around 1970 an ounce, and the short-term uptrend in crude oil still holding intact. Looking at stock sectors, we're a bit mixed out there today. ARK was one of the losing sectors back below its 50-day, and Jets as well, now looking to be in a full-blown pullback after being ripping high this last couple of months. The strong home builder sector looks to be peeling back a little bit on a bearish divergence, and the defensive sectors as well continuing to trade a little soft, with utilities actually coming off 2.2% today. BlackRock just closed underneath its 50-day VWAP for the first time in a few months. JP Morgan continues to trade strong, and just another look at Apple after hours, down almost 2% and still below that key 190 level that I'll be looking at tomorrow to see whether we can hold that or not. Microsoft's up a little bit after hours, same with the others like Google. Amazon's still doing really well, up almost 10% after hours, and NVDA sitting right at its 50-day for the first time since the start of the year, and that too may look like it may be lost tomorrow or next week. Tesla's below its one in a short-term downtrend, and Meta's still holding up there as well. Over to meme stocks today, pretty mixed across the board. Still seeing big moves up in Nikola after they get those surprise orders. Other EV makers are doing well as too, with Rivian and Neo trading up today, and the bank's doing a little bit better today, maybe starting to like those higher rates. Okay, so back to the S&P 500. Looks like we got a little continuation today from yesterday's move down. However, it did appear to be dip bought, and like I've showed you, we've got a lot of key indices and stocks sitting at the 50-day VWAP, which I mainly use to determine if the market is in an uptrend or downtrend, as well as looking at a bird's eye view of all the stock sectors here in our sector trends table indicator. We can see the vast majority of sectors are underneath their immediate term trend 5-day moving average, all of them except energy, oil and gas, and most of them are now underneath their 20-day moving average, and we've got about a quarter of them underneath their medium term 50-day average, and same with the long term. So we've got Apple trading down after hours, but contrasting that is Amazon doing a lot better on the upside, and we'll just have to see where the balance of the weight lies tomorrow. And if we get a bit more further selling and deterioration in breadth, we may soon see the majority of sectors below their medium-term 50-day average. And just looking at the S&P 500 weekly chart here, we may have found resistance at that 4,600 level and have a bit of a pullback, even if it is only 300 points down to 4,300. Where we last turned back here, we could find support around this level and still retain this medium-term uptrend. However, if we were to do a deeper pull back below the 50% level of this move and get below 4,200, then again I would just call this a kangaroo market up and down. It's neither a bear nor a bull market. But that's all for today. Thanks very much for tuning in with me. Make sure you come back to the channel tomorrow where I'll dive into the non-farm payroll report and how the market reacts to Apple and Amazon's earnings and see where we are heading into the weekend. And finally, I'll leave you with a clip of Jim Cramer's famous meltdown on CNBC 16 years ago. Enjoy, guys. Cheers.
Open the darn Fed window. He has no idea how bad it is out there. He has no idea. He has no idea.
Kramer.
I have talked to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None! And Bill Poole has no idea what it's like out there. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
Kramer.